There is a little doubt that pandemic has been harsh on the unorganized sector. It is reflected in the performance of the bottom of the pyramid lenders. But unlike many, Mass Financial did not pile up toxic assets during the pandemic. Though the asset quality worsened a bit, it wasn't a drag on the balance sheet because of the razor sharp focus on collection. However, growth suffered. The stock's severe underperformance with a 24% decline in the share price in the past 1 year against a 41% rally in the Nifty captures these concerns. The future, however, does not look to be so bleak. In spite of the challenges, Mars has maintained the balance sheet quality. It is adequately capitalized, has diversified funding pool, and is guiding to growth as the economy recovers. If COVID situation remains under control, Mars Financial's goals of doubling assets under management in 3 years may translate into robust growth from FY23 onwards. With the valuation at a similar level as its IPO pricing, the worst may be behind and the best is yet to come. Mars Financial is a small NBFC with a presence in 7 states, predominantly in Gujarat, and primarily focuses on 4 product categories. They are micro enterprise, loans, small and medium enterprise, two-wheeler, and commercial vehicle loans. The company also has a housing finance subsidiary catering to affordable housing. Mars has a unique distribution model of revenue sharing with NBFCs that source close to 55% of total assets. This model provides better last time connectivity and underwriting as operational and credit costs are shared. The quarter was marked by lackluster growth in assets under management and a softer interest margin on excess liquidity that resulted in a decline in net interest income year on year. Provision was sequentially lower on the back of improved collection that supported the marginal quarter on quarter rise in profit. So far, Mars has managed to weather an extremely difficult phase with cuts and bruises, but no deep wound. In the last reported quarter, the gross and net stage 3 NPA assets were more or less at a similar level as the previous quarter at 2.3% and 1.8% respectively. The company has restructured loans to the tune of 29.5 crore rupees. The provision cover on stage 3 is close to 32%. In addition, the company carries a buffer provision to the tune of 49 crore rupees. Credit cost is expected to normalize from FY23, with collection efficiency reaching 97% in the September quarter and the economy clearly on the mend. We feel the worst in terms of asset quality may be behind. The company had gone extremely slow on disbursement in the wake of COVID. Disbursement started picking up from the second quarter of last fiscal and accelerated in quarter 4 but contracted again in quarter 1. However, in quarter 2 of FY22, disbursement bounced back with a sequential rise of 42%. The assets under management has largely stagnated in the past year as the focus was on collection and the quality of the book. However, with diversified funding base and adequate capital, a capital adequacy ratio of 25.6%, the company would like to embark on its growth journey as the economy improves. It is guiding to doubling its asset under management in the next 3 years. That translates to a growth of 20 to 25% in the coming years, beginning FY23. Mars has a housing finance subsidiary which is into affordable housing. It perceives housing as a key growth driver but was cautious on lending so far. The book grew by 2% sequentially in the last quarter. The asset quality was a tad weaker with a gross and net stage 3 assets at 0.65% and 0.46% respectively and a restructured book of 0.9% of asset under management. However, it carries a buffer provision to close to 1% of asset under management. The company has a very high level of capitalization of 51.6% and could accelerate growth as the economy improves. The pandemic has been a speed breaker for Mars. However, with better quality of balance sheet and its focused approach to quality-driven growth, the earnings trajectory looks promising from FY23. Thanks to the underperformance, the valuation has corrected to a level that was prevailing at the time of its IPO in 2017. Severe economic impact due to COVID is the only risk factor that investors should watch out for. However, we see this weak phase as an opportunity to go long.